what the actual markets are doing here. We have our S&P 500, sorry, our SPY ETF representing the S&P 500 candles, and looks like we have been in somewhat of a downtrend. We're looking at the 30-minute chart here. Momentum, however, looks like we have made a higher low on the MACD, so that's a positive sign. The RSI is still down at 30, so that means downside momentum is locked in at least for the next week. And in terms of our relative assets, we have the 30-year U.S. long bonds in dark purple here and gold both outperforming pretty handily. Even high-yield bonds are outperforming in red. So that's actually a positive sign, especially since the high yield on a relative basis is coming in above our green key June baseline there and the 33 kind of royal purple EMA. So the fact that it's saying that this is basically where large cap U.S. equities risk should be is in line with the high yield bonds. So if that were to converge, that would take us above the sort of key pivot level here at about, let's go ahead and switch up to a non-percentage basis. So that would take us to about 204.2. So that's a key level we want to keep an eye on to have any kind of bullish action. We do have the gap that was created from the open, so that area will likely fill if we do end up having a rally. So it's very important that we push above this low 204 area and continue to rally into the positive phase of the Ichimoku cloud. And given our standard intervals here, we're going to be looking for upside action within 16 bars, so we're definitely past that threshold. Basically, if we do end up getting a few closes here above at least our conversion, our white conversion dot here, and we'll say the 20 Bollinger at about 203, those will be the initial positive signs. But really, we do want to see the RSI come up above 50 and see price action put in a couple candles above this 204 area. So in terms of the VIX, looks like we are flirting with 20 yet again. However, we have seen the VIX making a series of lower highs over the last few months, so that is a positive sign. Momentum, however, is trending up, and price action has printed a couple candles above that, so we're basically at a stalemate here between momentum and what the overall price structure is telling us. One of the key things is the 8-day rate of change, and that is positive and rising. So that tells us that the VIX momentum is definitely to the upside. So we can expect volatility to be elevated for at least the next week. And in terms of major horizontal levels, looks like we might be looking for resistance around 21, and maybe some support or pivot around 17.5, 17.6 maybe on the VIX. So levels to keep an eye on. But for the time being, as long as we're above these moving averages, expect the VIX to remain elevated. And because we printed our last closing low just a few days ago, 6 trading sessions, you really want to wait between 9 and 16 trading sessions of VIX rallying above that key 33 EMA before you start selling volatility and going long risk. In terms of our overall asset performance, looks like those long bonds, which I did recommend recently, are doing very well. And China, surprisingly, is doing well as well, and utilities, and these are all on a 1-month basis. As far as the ones that we want to stick with, we're looking for relative strength, and the U.S. long bonds are the only one that has that. We want relative strength of at least 55, but usually greater than 60, and so we've got that with TLT. We've also got that with the U.S. dollar, the UUP, as well as nice 1-month performance. And we're above our 50-day moving averages. And then in terms of weakness, we are looking at some of our worst performers are Coke, which is Never usually a good emerging market sign, just because so much Coke's revenues are derived globally outside of the US, but also considerable weakness in Europe, silver, Japan, emerging markets. Looking at RSIs, we're looking for below 55, but preferably below 50. Looks like any one of these you could stick with on the short side. These are all definitely sellers, and they're all definitely below their 50-day moving average. The last criteria as far as value would be anything that hasn't really sold off so hard on the quarter. So it looks like Japan is still there, Coke is still there, and EFA, sort of the global developed large caps, is also there. So those would give you kind of the best bang for your buck on the downside. Thanks for watching the Dorsey Report. Hope you guys found at least some of this information useful. And if you did, please like, share, and subscribe to my channel if you'd like. There's also a feedback link just right down below. And until we speak next time, good hunting.